Hello, everyone. This is Brittany Button. I'm a long-term care insurance specialist here for Art Jetter and Company. Joining us today, we have Alyssa De La Cruz with Nationwide. Today, as you know, we're going to review Nationwide's new CareMatters Together hybrid long-term care insurance life solution. Now, we're very excited about this policy. It not only is it somewhat unique with some of the features we're going to review, but those of you familiar with One America's Second to Die joint asset care policy, this is going to be a very similar option as the way it's structured. So before we get started, you'll notice I've got a couple handouts in the download area. Make sure to get those on your desktop. Also, if you have any questions throughout the duration of this webinar, feel free to input those into the questions or chat box, and we'll address those at the end. So, Alyssa, let's get started.
Really, thank you, Brittany. Thanks, everyone, for hopping on. We are truly excited. It is launch week for this solution, and we are excited to be the second in this space, but the first with a cash indemnity option. So we are still holding true to what you love about Nationwide, which is that cash indemnity benefit, but just really now adding that ability to save on some of that premium and get two insureds on that same contract. And that's really our goal there, is to just give you another opportunity, especially if you're looking. I know how many of you have spouses that come together and be able to really get the benefit of a joint option. So if you are new to looking at Nationwide or just long-term care in general, I'm going to cover a couple of things in the beginning just so you feel comfortable with it, and then we'll dive deep into some of the features and new opportunities you have within the CareMatters Together space. And then we'll obviously go over some of those differences as well that might be a little bit different that you're not used to and I want to spend some time. But of course, if you have questions, make sure you throw them in the chat box. Chances are somebody else has the same question, and we want to make sure we get those answered for you. So if you are looking to add the option of long-term care in your book of business, and this is something new to you, it is such a phenomenal space to be in right now. There is no better time to be working in long-term care than there is right now. There's such a huge need for it and a misconception of the value it adds to somebody's retirement plan. Sometimes individuals still think long-term care, clients think of long-term care as a nursing home. It is a place and not really an event. And that's our goal here, is we want to create more solutions to help prepare for this event and provide a dedicated income stream that is guaranteed and protected for them in a case of an event like this, so that it doesn't derail the plans that they've already worked so hard for, that you've already worked so hard for, and be able to say we've already have protection and a plan set in place. Not all plans include insurance, but I do believe the great ones do. And it's still worth having the conversation and diving deep in with your clients to really get an understanding of what they're looking for when it comes to, one, potentially staying at home, or what that would look like if they did need that in retirement. What is that plan? And if it is an insurance, what does that look like? And really breaking it down for somebody to have a good understanding of what assets are going first. And sometimes that helps open up that opportunity to say, maybe this isn't the best opportunity. What else could I do? Versus leading in with a solution. So with that being said, what can planning for long-term care provide? It gives you that opportunity, especially depending while you're having this conversation, it might provide funds to keep a client at home as long as possible. That's usually a lot of individuals' goals. We know most individuals prefer to stay at home as long as possible. And if that's the case, you want to know that. What is that plan? What does that look like? Some people will outright say, hey, I don't want to do that. I want to go into facility care. But they may want to have the option if they decide that looks different in 20, 30 years. It helps somebody maintain their current lifestyle, especially for that healthy spouse. It does help their own health on top of it. So there's things like that, preserving their retirement income. If they're trying to also leave a legacy, making sure that's provided for them. And also some misconceptions that might be out there, whether they think their health insurance provides it, maybe they think Medicaid might be that option, but not really understanding how you get to that point of needing and getting on those services, and what does that really look like, and is there a better plan for that? So usually when somebody does need long-term care, there's three buckets that they may come from incoming in sense of funding it. It's maybe a lifestyle, which may be the potential cost of a loss of health for a family member, a spouse, because they are providing that care. And in many cases in America, that is the case. It is somebody in the family taking on that responsibility. And that may very much look different in the next couple of years. It already does look different, especially as I know for myself, that will look different for when I need long-term care. Versus when my mom or my grandmother would need it, where my grandmother, all of her children live in the same city, versus my mother, none of her children live in the same city, and maybe not even the same state. So those are different things that you have to come and have that conversation with, because it's going to look different when I had that experience versus when my mother has that experience or my grandmother has that experience. Income, it may very much come from income, if not also lifestyle. It's a dollar for dollar expense. It is, I'm going into an asset and I'm taking that out. And in some cases, it may even be more than a dollar for dollar, because you may be looking at taxes if you're liquidating assets and things of that nature that are adding to that cost, or that loss of growth from those assets, because you may have to be taking out substantial assets to cover that. Not that that's necessarily a bad plan, but is that the best plan in place? Is there something that you could already set up in place, like insurance, to really have a cost-efficient leverage in that situation? And that's really where the advantages of a linked benefit policy comes into play. If you're familiar with our CareMatters solution, we only had it originally as of last week on an individual basis. It wasn't an opportunity for you to do it joint, but it's still, the advantages itself still exist. You have guaranteed death benefit and premiums. So that is really where it offers peace of mind for your clients, knowing that if they've been familiar with long-term care, maybe they've experienced it with a loved one, maybe they had a policy and it was more in that traditional space, where those opportunities weren't there, where they had those guarantees, or maybe dealt with, hey, I'm dealing with premium increases. That is not something you have to worry with in a linked benefits solution. Everything's locked in and protected. Also, there is a death benefit. So if they don't use their long-term care, there's still something they're getting out of their policy, and provides immediate leverage on a guaranteed pool. So if that claim happens today, 10 years from now, they know exactly what they're getting. Their leverage is there, versus how long will it maybe have to grow to get to a specific value if I'm investing it. And maybe that claim comes in 5 years versus maybe the 20 years I needed it to grow for to get to a value that would cover these costs or help protect me from that. With that being said, we now have a joint option. So we certainly have it on the individual basis. Nothing's changed there. We did have some enhancements, so I will touch upon that just briefly. So as of this week, we also had price improvement on our individual policy. So if it is something you've looked at as of last week, that price has improved. We also were able to drop the initial starting point of planning for long-term care. So your monthly benefit used to have to be $2,500 a month. Now that's dropped to $1,500. So that really opens up that opportunity for somebody that may have had budget constraints before. You can start off at a lower benefit to bring that premium down. So meeting your clients where they are. So that was just some of those advantages there. If you are in New York, the enhancement we had there was now there is no couple status anymore. Everybody gets the pricing as if they were a couple. So if you're familiar with our individual side, there were single rates and then there were couple rates. In New York, that no longer exists. Everybody gets the couples rate. Now they're still on the first iteration of our product, so we don't have that second version, but that is an enhancement we had there as of this week as well. So let's go over some of the great features CareMatters Together has and what makes it different. So it obviously is the first cash indemnity solution in a joint life-linked benefit solution, and brings that opportunity for a more cost-effective solution for 2 lives versus maybe doing 2 individual policies. In the sense of simplicity, you are sharing some of the advantages it offers is you're sharing a pool of funds with that other individual. So maybe it's 2 spouses in this scenario. They're sharing that pool. So in that case, maybe one uses it, maybe they both use it, maybe they kind of share it half and half. It is up to them however they want to do that. There's predictability in the sense you know exactly what they're paying, their benefits they're getting, and death benefit. Everything's locked in and guaranteed. And we offer that opportunity of more control with knowing that you have a cash indemnity benefit. That means you get the full benefit every single month. You don't have to show receipts for it if you don't need it all. then you don't have to take it all, but I always recommend taking it all, but it's up to you to deem what's important to you at that point. So it really gives you that control aspect of it with a cash indemnity solution. So let's dive a little bit deeper in that simplicity option and how it really works. So if in this section, we don't necessarily have years of coverage that you might have previously looked at before. What we're doing is LTC benefit payments. So we have 48 months, 72 months, and 96 months of payments, and that's shared however they deem necessary as those two insured. So we don't say, hey, you have to have half of it go to one person, the other half, however you want to use that. So it's shared and you can do what makes best sense for that individual. So I'm going to dive a little bit more into what that would look like on claim so you can kind of see how that might play out. But those are the three options you would choose from. And some questions I've had is, do they have to, if they're both on claim at the same time, do they have to share that monthly benefit? No, they get that full amount each. So if your benefit's $10,000 a month, one person gets that, the other person gets that as well. It isn't you split the 10,000 and get 5,000 each. You get each 10,000. So let's look at Monroe and Dolores. So Monroe goes on claim for 2 years, passes away. Dolores does not go on claim. She is fine and healthy for another 2 years and is able to use the rest of her policy that she has. So he used 24 months of their 96 months of benefits. She got 72 months of payments that she could utilize. So that could be a realistic example of how that might play out. Well, what if we both go on claim at similar times? Likely probably not at the exact same time, but that could happen as well. So let's look at Stephen and Michael. Same 96 months. Stephen goes on claim for 42 months, passes away, but during that time, 2 years into that claim that Stephen was having, Michael also now went on claim. He stayed on claim a little bit longer. Well, he has 54 months to also use because Stephen used 42 at that point. So that could be an example that plays out as well. The last one could look very realistic too. Maybe in this case, we have John and Lori. Lori could have, how I see this example maybe playing out versus maybe saying, hey, why did John decide to use all of it and Lori didn't get anything left? It could very much be that Lori didn't take any because she was going to provide that care for him, realized the cost would be minimal. So in that case, she was able to bank majority of those benefits, and whatever wasn't utilized for John's care, she's able to use. So she got everything out of the policy. And if she never had a claim, well, that was already with her in her savings, reinvested however she wants to use it. It's out of the policy for her to use however she deems necessary. So that's one way that could play out in that example too, if they knew going into it that one of them was going to provide the care for the other person and try to use all their benefits and get everything out of it as quickly as possible. So that could work out in that example too. In that sense of predictability, again, I know we talked about it, guaranteed premium, nothing's going to change there. If you decide you do not want to continue making your payments, you can reduce pay up the policy. Your benefits are guaranteed as long as you continue to make your payments, but if you decide, again, you don't want to, you can reduce pay up your policy. The death benefit is locked in. In many cases, you will get what you put into the policy is what you'll get back in a death benefit format. Usually where I see that vary a little bit is on the 5% compound. So if you've chosen 5% compound, you may not get that full death benefit that's equal to your premium, but you're still getting a significant death benefit if that doesn't happen. We're just more leveraging how much that long-term care value is growing. And then everything continues to grow. So that's a question I've gotten a lot is, hey, if we go on claim, will the inflation stop growing? Absolutely not. It will continue to grow as long as you've chosen to have lifetime inflation. If you didn't, then it would stop at some point, but it will continue to grow. We don't stop that at any point for you. We've talked a little bit about cash indemnity versus reimbursement. Just remember, you're not collecting receipts. You're not dealing with bills at that point. So those clients aren't coming to you to ask that or manage that. It is now they know, like we showed in those examples, some examples, $10,000 a month. They get that every single month. They don't have to show a receipt for that. It is up to them to determine how they use their benefits, if they need to save them, or if they decide they needed to use it all for all the expenses that they had, or cover a lot of incidentals that can come up in long-term care that's not usually reimbursable, such as medications. Chances are if you're on long-term care, you're going to have medications, and that could be a high cost. Maybe things like mowing the grass, paying for delivery service to have your groceries, DoorDash, whatever it may be. Those are costs that come up, and that's a nice way to know that your benefits can cover that if you wanted to, not necessarily something that might be reimbursable in many cases. Let's focus a little bit on some of those key features that might be really important to know, where you can place this, where the clients you're looking for in this situation. So the minimum age is still going to be the same that you're used to, which is 30. You can have this conversation younger. Don't be afraid to have these conversations younger. Chances are a lot of these individuals, we are seeing an increase in millennials becoming caregivers. So chances are they are being exposed to this, and they may be something they want to do, and there are payment structures to allow them to maybe continue do a 20 pay, a pay to 100 to bring down that premium, but still protect themselves in those situations while they have one of their greatest assets for them, which is their health. That's one of your biggest assets you have, is your health. The healthier you are, the younger you are, that's the more leverage you're going to have. And that's certainly something that should never be disregarded and waited for. The healthier you are, the younger you are, more opportunity to have that leverage and have your dollar work harder for you. Now, the maximum issue age on this product is going to be 70. And if you are 70, you would only have 3 payment options. You have single pay, 5 pay, and 10 pay. If you are 65 and younger, you have all of these options, but the cutoff point for a 20 pay and a pay to 100 is 65. 20 pay is new to our solution suite of CareMatters. So that really was important to us to be able to offer you something, especially for somebody that might be in their 60s and doesn't want to do a 10 pay, but doesn't want to pay for ever either. They have that opportunity for a 20 pay. Now, there is something I do like to point out, because this one is an opportunity, but also something to keep in mind. There can be an age gap difference. So this gives you an opportunity for some individuals that might potentially have an insurable interest with siblings or parents. Sometimes people call it mother-in-law or in-law insurance, if you will. There can be a gap of 25 years. So you have that opportunity to maybe insure a mother and daughter, siblings. I've had that one come up as siblings that had maybe lived together and were essentially sharing expenses, those kind of things. They had an insurable interest in that case, and that was something we can consider. Now, I'm going to touch in the next slide about underwriting, because that's going to be a little bit different than you're used to from Nationwide on our long-term care space. But if there is a standard of one of these insureds, then that age difference does drop to 10 years. So underwriting is a little bit different on our joint option. One, to give you more opportunity than you've ever had before, but I want you to understand it's not going to look the same as maybe life insurance when you're looking at preferred and standard. So we obviously are going to have a couples rate, because that's already naturally built into the policy that you're used to. You will have a tobacco and non-tobacco rating. But if you're used to our, or pretty much any asset-based product out there, in that sense, if you sent something in before for CareMatters and they got approved, that's going to be that preferred class. And essentially what falls into that realm is anybody can be preferred up to a table D, as in dog. D as in dog. You can be preferred and have that risk. And that was essentially what we could take on CareMatters 2, CareMatters 1 of our solutions. That's where that underwriting. So if you're used to that, and that's the kind of clients you were sending in before, they would get a preferred status. Now, to really open up that opportunity that wasn't really there for us before, and also to match what's in this industry and in this marketplace for a joint product, we wanted to be able to get to a table H as in Henry. That's where our standard class falls into. So table E to H gets you a standard rating. So now that opens up that opportunity that you didn't have before for clients that we may have previously had to say no to. So you do have that. Now, if there are 2 standards on a case, we will have to decline that case. So that, I want you to have a good grasp of what standard means, because typically if you looked at life insurance, you might think, oh, well, standard should be fine. But in this case, for our long-term care asset-based solution, standard is obviously a heavily rated individual. So we can only have one individual be standard. One has to be at least preferred. Now, we will continue to pre-screen clients. So if you're unsure, you can give us a call and speak to an underwriter. You can talk to us, and we're happy to do that. You can obviously tell Brittany and her team if you aren't sure either, and we also provide an email so that you can pre-screen individuals that you're not 100% sure on, so that we can get you a good answer as to if it's something you should move forward with, something that you might have to wait on, or if it's something that would likely lead to a decline overall. The product minimum on this product is also $1,500, so we matched our CareMatters 2 product with this to make sure that aligned equally for you. Only in these 3 states that you see listed before, down, South Dakota, Vermont, Wisconsin. If you happen to see it's not $1,500, it's because it is a state mandated minimum that they have. But outside of those states, $1,500 is that minimum starting point in an LTC benefit. So really bringing it down to have a much more affordable premium for some individuals that are starting out. The maximum will match what you're previously used to. So you can start, the maximum starting LTC benefit is $20,833. You can still add inflation to it. It just cannot be higher than that in that situation. Another question that has come up is, well, what if they already have an individual policy and maybe this is something they wanted to do to add more additional coverage and also cover maybe a spouse? You can absolutely do that. We are just looking at these minimums too. So if it happened to be that you're getting $10,000 on the individual policy and $10,000 a month on the joint product, we can still take that because combined together, they don't exceed the $20,833. So you do not have to worry about that either. I know we already talked about the payment options, so obviously they're up there on the screen for you. What I do want to share that is new to our suite of products is our waiver of premium. So before, on our individual policy, and still is the case, we could waive the LTC premium on the pay to 100 option, but essentially all the other options, you needed to continue to pay your premiums to maintain that benefit if you were on claim, or you could reduce pay up. In this case, we are waiving it while you are on claim entirety, the whole premium. So if you are on claim in year 8 of doing a 10 pay, then you're on claim for 4 years, you're not responsible for those last 2 payments because you are on claim. It is waived. Now, if you happen, this question did come up as well, so I do want to make sure I spend a second on it. If you have an individual that is on claim, let's say on a 20 pay, and they go on claim in year 10, they're on claim for 4 years, and then they pass away, and there's essentially still another insured that is still living and healthy, there's technically 6 more payments that need to be made. Then that person would need to continue to make those premium payments to receive their benefits, if you will, in that situation, but they're not responsible for the 4 that were waived because that first insured was on claim. Now, if he or she was on claim as well, then that's still waived anyhow. But that's the only instance where I could see that happening. But in most cases, I'm sure that's not always going to be the case for someone still on claim in the middle of a payment structure and the other person isn't. But just keep that in mind while you are on claim, or as long as one person's on claim, the premium is waived during that time period. Inflation is going to look similar. What will be different is we will add the 20-year 3% compound. Again, just another lever for you to pull to customize your solution. Could be also to bring down that premium. Maybe you're dealing with somebody that is 60 years old. They want inflation. They're going to pay for it for 20 years. It will inflate for those 20 years. Then it will stop growing at that point. They bring them to their 80s. And maybe that is comfortable for them to say, hey, I'm happy where it grew and saved on that premium. You could do that now. So you do have that opportunity there. Or you can choose to have 3% or 5% compound for the rest of your life. Now, I will stress on the joint product for us at Nationwide, that inflation grows on the entire benefit. You don't start off with a lower, maybe your acceleration of death benefit portion doesn't start off lower. You don't have to pay to have inflation on that first bucket. You get inflation the entire time your monthly benefit continues to grow. We do value that and feel that is very important to your clients to make sure that they have that inflated benefit the entire time they're on claim. So just keep that in mind. Now, this will be unique in this space on a joint product for an asset-based product. We are still going to keep what you used to and see from us, which is a residual or guaranteed minimum death benefit. On our individual policy, that's 20%. That's always been an industry leader. In this case, the other carrier does not have one, so we have one. It will be 10% of your specified amount. What that basically means is if you use all your long-term care benefits, there is still something that is paid out to those beneficiaries on a death benefit format. Usually I see a lot of individuals refer it to as maybe burial costs, anything like that, that is still promised to you. So if your death benefit's $200,000, then your residual in that situation would be $20,000 that's still paid to the beneficiaries if they went through their long-term care. We've still built it with the purpose to have tax advantages. So if you are used to CareMatters 2, that is still that case here. We do separately identify the premium, so that gives you that opportunity on the individual basis and also on the business side. I will say the individual side is always a little bit harder to achieve because of how the rules are written and the minimums you have to, the floor you have to meet beforehand. But where I see the opportunity on an individual basis is if they have an HSA card. If they have a lot of medical expenses, that is still an opportunity. But if not, if they have an HSA card, it is an opportunity for them to get their premium, get some portion of their premium back. It will be age-based limit. So the older you are, that pool is a little bit bigger. The younger you are, the smaller it is, but still an opportunity for somebody to be able to get that out of their HSA, just like purchasing glasses, contacts, or co-pays that you may pay. This is an opportunity that you can use that card for it. But I would see that biggest opportunity for a lot of business owners, especially family businesses, where they may want to cover not only themselves, but cover their spouses. This is a great opportunity to do that with a joint product. Elimination period is still going to be retroactive. So each insured still has to meet their elimination period, which is 90 calendar days, but it only has to be met once. What I will say here is something I do here. It does not matter what kind of care you are receiving during those 90 days. So if it is a spouse stepping up or a family stepping up to bring down that cost to provide that care, that is okay with us. We are not going to say it has to be somebody skilled, a healthcare provider or a nursing home, assisted living, anything like that. It does not have to be that case. But what we will do is retroactively pay those benefits back. So you still have to meet the 90 days, but you are going to be made whole on any cost that you have. You don't have to provide receipts. So if you were able to say, hey, I brought that cost down because my spouse took care of me during that initial stage, then that's your benefit to use however you deem necessary. So if your benefit's $10,000 a month, day 91, we are processing those 3 months you did not get, plus that 4th month. So you are getting a check for $40,000 to use to recoup costs that you may have had. Maybe it's to put in your savings account for costs that might start to increase on a given month. Maybe you need to make home modifications. There's a lot of things that may come up initially that you may not have thought of. That's a great way to start it. But if not, it is something that you can draw upon as maybe the claim gets more expensive and maybe you need more than $10,000 a month. You have a pool that you've been able to get out of this policy to dip into if that's the case. You don't, again, have to take it if you don't want to. It can stay in the policy, but I'm always going to advocate for you to get your money out of your policy as quickly as possible because it's yours and you should use it how you need to versus passing away and it staying in the policy. International benefits is going to look similar like you've seen before. So essentially your benefits are built on, you have a acceleration of your death benefit portion that equals your long-term care monthly benefit, then you have an extension pool. So how it works on this particular product, the acceleration of your death benefit is on a preferred individual is going to be 36 months. So if you chose 48 months as the payments that you wanted to choose, then 36 of those months is essentially an acceleration of your death benefit, and the last 12 is your extension. For international benefits, why this is important to keep in mind, if you have clients that are thinking or going to retire out of the country is, and this works pretty much the same for all carriers, we follow very similar guidelines, but we'll pay 100% of the acceleration of death benefit portion. So that means if you're a preferred, that's 36 months. So that's an important thing to bring up to Brittany or to your nationwide team to say, I know they might do that because we might design that a little bit differently if we know that, because we want to make sure you get as much as possible. So if you're preferred, I don't want to pay want you to do 96 months when you're only going to get 36 months if you're going to retire out of the country, and the rest would only pay if you came back to the United States. So in that case, I might design it with 48 months to make sure you're getting 36 months plus inflation during that period. That might be the best situation. Now, if your standard, how it's built is a little bit different, that actually is 48 months in that situation. So in that case, if you chose 48 months, you would get that full benefit at a standard rate in that situation. But it pays that plus its inflation during that time period. What I will say, if you do have clients in that situation, is think of the difference of what cash indemnity can do versus reimbursement. If you are in another country trying to receive benefits, it's likely going to be potentially easier with cash indemnity policies to get your benefits and pay for the kind of care wherever it may be or whatever it may look like, versus having to submit receipts and see if what kind of expenses you are incurring internationally are reimbursable, or facilities that do they meet what they need to be reimbursable. In that case, I think that ease of use can really help with a cash indemnity benefit. We also want to make sure that we're there every step of the way for your clients, in the sense that what happens when you go on claim, what does that look like? So we do provide you with pieces on this, how they can go ahead and reach out to us, or if they're reaching out to you to have that conversation. We will always try to help the client if they're reaching out to us or their family's reaching out to them, to understand what's going on, to make sure we can identify for them that if it is a long-term care claim, we will send out packets for them. We will also help them get started. So usually you have to go and see maybe a physician, or you've already been seeing a physician that's documenting your need for long-term care. We can go through doctor's records as well, but sometimes that may take a while, and sometimes doctors aren't always the best at getting paperwork filled out or not knowing what insurance companies need. We can take that responsibility as well and actually go through that process. If we can pull up the records relatively quickly and find that information, we can go ahead and move along with that process and not necessarily have to have that physician step in that situation. Sometimes the records are good enough for us to be able to do that and make that decision. We can go as far as creating the plan of care as well. So the plan of care is what you need to go on claim, which is essentially, what does that care look like? Who's going to be taking care of this individual, providing medications, whatever it may be. That needs to be listed out, part of your claim paperwork, essentially. But where people were having issues before is if that ended up being somebody, maybe a spouse or a family member. It's not usually the doctor that would do that. Usually maybe a home care agency will do that. So we've stepped up to make sure we can go ahead and provide that for you. So if it is going to be, hey, I'm not going through maybe skilled care initially, and those are the individuals that typically write your plan of care, we can go ahead and do that. So if it's, hey, it's my spouse that's stepping up to do this, we will create that plan of care for your individual, so we can make sure that we're going along with that claims process for that individual. We want to make sure we make that process as easy as possible. We also have a caregiver advocate site that helps individuals and their families, so they can share it with their family members before claim, during claim, after claim, however they want to go ahead and do that. That allows them to find care in their area. So if they're not sure where to start and don't want to necessarily be Googling, how do I find an assisted living, nursing home, home care agency, we can go ahead and help them find those places for them and give them the research that we know on them, have a list for them so that they know who to reach out to. But on top of that, that site also gives them a lot of information prior to that. How do I interview somebody if I'm not necessarily going to be the caregiver, but I want to manage that and keep that person at home? What should I be asking for? What kind of things should I be looking for? How do I'm starting to notice maybe myself, or if I'm looking at this as a family member that had access to it, how do I know my loved one is maybe showing signs of needing extra help, or maybe is this a sign of long-term care? All those things are in there for that individual as support that they can share for themselves, but also share with their loved ones through their access to that site. So we try to make that a really easy process for them. Obviously, you know, Nationwide story, we are a mutual company. We truly believe in delivering for our members. We've been in the long-term care space for nearly 25 years. We've started in the LTC rider space. We still have that space. It's something we want to continue to grow on. And that's why we delivered a joint option for you. We want to show you our commitment to this space and continue to grow our solutions for you to meet what your clients are looking for in the long-term care space, but also be able to give them a cash indemnity benefit. If you are curious about underwriting, I do want to spend a second on that as well. It is going to be similar. You're not doing blood and urine. It is an interview process. We can do that over the phone. We can do that digitally. I will recommend digitally because I feel it is an easier process in general versus having to schedule time to talk to someone on the phone. But it is available for either option. We've just seen a lot of success with the digital aspect because it is quicker for someone to just look and do drop downs and answer questions relatively quickly. Most of the time people do this in bed. They do it 10, 11 o'clock at night and can get that done in about 30 minutes. And they can stop if they need to. So if they're not sure about a question, I need to look at it, they can come back to that interview process. The cognitive screen is still going to be over the phone, but we are working to get that digitalized for you as well, just to make that process even easier for you. I will also say, if you look at the traditional space as well, keep an eye out for this product in the joint option. We've seen it become very competitive. In some cases, it's equal, if not maybe $20 more a month to have this guaranteed solution if you are looking at the traditional space. So if it is something that's where you naturally lean before, or there was a budget to keep in mind, keep a look at this product and see if that still maybe delivers an opportunity for you and also gets all those extra advantages of death benefit and guarantees that you might not have looked at previously before. So with that being said, I want to see what questions we might have had in the chat box, Brittany. If not, type them in. But we're really excited. While Brittany maybe looks that up to see if we got any, we're really excited about the solution. If you have questions, we want you to ask. If you see something that you're not sure about, Brittany's happy to answer. We're happy to answer, but we want you to feel comfortable in this solution. We're excited about it. We think this is just going to give you just another opportunity to have that conversation more often and bring that premium to a much more reasonable spot for individuals to have that conversation versus waiting another 10 years because maybe that premium doesn't work with them. But hopefully we're being able to deliver you with the payment options and product minimums to really have that conversation earlier and more often with your clients.
Perfect. Well, thank you, Alyssa. You did a great job today. And yes, we have questions. Now, I'm noticing a good handful of them were answered later on in the presentation. So for those of you asking about residual death benefit, the split of identifiable premiums for tax deduction, international benefits, and underwriting requirements, if Alyssa didn't get those covered or you may have missed them, please feel free to give us a call at the office. We can go over those again. Now, regarding state approval, there's only a handful of states this is not available in. So we're looking at California, District of Columbia, Montana, Arizona, and New York. Unfortunately, CareMatters Together is not quite approved in those states, but almost everywhere else. So very excited to be able to offer that. So Alyssa, first question coming up. Can you kindly comment on replacements in terms of state mandated cash values or guaranteed years remaining from the replaced LTC policy? So I guess if you could just touch on Nationwide's view on replacements of not only standalone long-term care policies, but also maybe a life insurance with an LTC rider. Is there any restrictions there?
No, there isn't a restriction on how you can go ahead and replace it. We're comfortable with that if you are, and it makes sense. So we certainly do reviews ourselves as well. So if you have something that, hey, maybe it's just not working anymore, or they want something different that's guaranteed, especially if it's a traditional policy that maybe they're wanting to get different coverage, we're comfortable with that. If you have a life insurance policy, obviously for this product, if it's easier on the individual policy to do more of those replacements, maybe you're doing it with a 1035 or something of that nature. It still has to be like to like, so that's been a common question. So if I have a policy on myself, but I want to get coverage for me and my husband, I can't 1035 my policy into this product because it has to be like to like in that situation. So I'd have to be maybe another survivorship product moving into that. But doesn't mean that I couldn't move my life insurance product into a CareMatters individual policy. So we have some of that. Another option you could potentially do is if you have access to SPIAs. I've had individuals do something like that where we can internally split a policy. So perhaps I had a large life insurance policy. I may split some of that for myself into a CareMatters product and then maybe put a portion of that into a SPIA so that distribution can pay for my spouse's. I'm still paying taxes on that distribution, but that could be a way to leverage that asset.
And given that, Alyssa, would you recommend maybe a cover letter? Say somebody wants to replace a old standalone policy, they're tired of the rate increases, and regardless if it's CareMatters 2 or CareMatters together, would you recommend a cover letter explaining the reasoning behind the replacement and that recommendation?
If you feel that it is in depth, but there usually is a place in the application that asks you to, in the section to say, if you are replacing it, can you tell us why you're replacing it? So that's usually enough for us to be comfortable with that. We're not usually going to harp too heavily on something necessarily. I haven't had issues in that sense of suitability when we run into that. We just want to know, most of our goals is just making sure you're not overly insured somewhere.
Perfect. All right. Next question up. I got this. We had some late attendees. No worries. We know how our days go. And when the phone rings, we answer. Good news is we do have a replay that's going to be available of this. If you're on this call, keep an eye out from an email an hour after the session from GoToWebinar. It's going to include a link to that replay. May or may not go into your spam, but if you don't see it after an hour after the session, give us a call. We can definitely send that link out. All right. Ooh, so many are coming in, Alyssa. I hope you have some time. If not, let me know and I can help answer these offline. So next question coming in, if one person, or I should say when one person passes away, is the premium that continues to be paid by the remaining insured still the full premium, or is it reduced because we only have that one insured now on the policy?
It is still that you have to maintain that full payment because you're still getting your full benefit in that sense. So you still have to do that unless you want to reduce pay up your policy. So you could choose to say, hey, I don't want to continue it and get a lower premium, but then your benefits are also reduced as well.
And that's going to be the same for the competition out there. Typically, we'll see that reduction sometimes with the standalone carriers, but that's pretty common. Ooh, all right. This one, I'm going to be interested for this answer from you, Alyssa. So I have an individual here getting referrals from their local nationwide P&C agent who is not health licensed. They're wondering, are the nationwide agents out there able to offer this same policy?
Yes, they absolutely are allowed to offer anything that we have. We don't discount it differently. It's all the same. So they're selling the same solution that you are and the same premium. It just maybe they aren't licensed for that. So sometimes they may prefer somebody else that has a little bit more knowledge to do that, but they can sell it if they'd like, or they can use you as a referral and have somebody that has more expertise to do it.
All right. And next one. So regarding underwriting, does Nationwide pull an MIB report? And I'm actually going to add to that. Does Nationwide report to MIB if a decline takes place?
So we do report. We don't necessarily say what it was, and it's not. I will also stress potentially no carrier in general uses that as the reason to decline somebody. We still have to go through our same underwriting to ensure that. It doesn't show up as a decline if it was like two standards, if you will. It's just a not taken product, if you will, in that case. So it's not like we declined you. It's just you don't meet the parameters within our product to have two individuals at standard in that situation. So we will always look at it to see, but it isn't necessarily something that is the indicator as to a decline. What we usually do also pull up is a prescription check. That's the most common thing we will do, is to check on what they've been taking in the last 7 years. That's usually where we can get our questions to see where they are health-wise, or see if things are being disclosed that maybe they're not. Maybe they're saying they're not diabetic, but we're also seeing insulin, as a prescription that might pose that question as to, well, are you diabetic? Why are you taking insulin then? Kind of a thing.
All right. So, okay, looking here again, and we have some redundant questions, so apologies, just taking a look through these. Okay, so still on underwriting. I knew there's going to be a lot of questions to this. Regarding the electronic personal health interview, can a couple have the same email, or do they each have to have their own individual email address to set that up?
It would be separate. We've had that come up just even on the individual individual situation. It just we can't necessarily identify them separately, so they would need to have a separate email. That makes that easier for us to make sure we're linking it up to the correct person and their medical history.
All right. So I can tell I have a California producer on here. I'm going to assume you're working outside of the state of California, but a couple questions because they're looking at CareMatters 2 in California.
Yeah.
Regarding eApp, is it on the older system or are you all utilizing the new Porch system?
Yes, so currently in California, it is only on the Porch system. We are working to get it on iPipeline, but currently it's only on Porch if you want an electronic process.
All right, and for those of you on the call, you can definitely access eApp, of course, through Nationwide's website. We also offer it available through iGo at Jetter, JETTER.com, and trust me, use an eApp if at all possible. We're just finding that it's such a quicker turnaround time, and we're getting folks policies at a much faster pace, and that's even more so if they can do the online personal health interview relatively quickly instead of the calling back and forth trying to schedule that personal health interview over the phone. So our team, we highly stress eApp. If you want to go through that process, again, feel free to give the office a call. We're more than happy to walk you through that as well. And all right, same producer, can the customer stop inflation during their policy? And I know that's kind of a newer benefit and feature on CareMatters 2 California.
So yes, only in California can they do that, but it doesn't necessarily change the premium. So it's an option you can do, but in most cases we would say, you could. It could change the premium on like a longer duration pay, but like if you did a single pay, it wouldn't make sense for you to stop your inflation. You already paid for the inflation. So that's that. It is something that California did require us to do, but in most cases, it doesn't necessarily make a lot of sense based on our payment structure, unless you're doing the longer pay.
Of course. All right, and folks on the call, we're going to take one more question. Those that did not get answered, we'll be in touch. I promise. You all were definitely listening throughout the session, and we're having great conversations here. But due to time and getting you all back to your day, we'll take one more question. And again, we'll reach out afterwards. Last question that came up is actually about the return of premium. Now, for some of you new to long-term care insurance, and especially the hybrid space, when we talk about return or even refund of premium may be used, we're really talking about the cash surrender value, should that client or clients decide to walk away from the policy. Now, in CareMatters 2, we have multiple options on how that looks. Alyssa, can you comment again how CareMatters together, if there's more than one option regarding that return of premium?
So it's only going to be the one option, which is kind of like your max LTC that you're used to from CareMatters 2, which is whatever the cash surrender value is at that point. And why we did that is because when we launched that on our second product, CareMatters 2, that take rate is about 80 to 90% is what individuals have done. I certainly understand that value of having 100% return of premium. It just was ending up that people weren't utilizing it as much because of the value that they would get to be able to just use a cash surrender value one and not a percentage. That leverage point was significant to them to say, hey, I would much rather have the long-term care than have that 100% return of premium once they saw what they were, maybe the cost going up or the loss of benefit for that premium that they had. What I will also say to that, as an industry that's a little bit different, when we look at this as a whole to see what people actually do with these policies and surrendering them, it's less than 2% chance that people surrender these policies. So I understand the value of having 100% return of premium, but when we look at that and what people are actually utilizing, people are holding on to these contracts. So our goal is to be able to get you that leverage of LTC. in that situation.
And just to comment on that, I wholeheartedly agree. Having 100% cash back sounds great. We had a competitor no longer in the market. That was their marketing go-to. But as Alyssa said, nobody's walking away from these policies. And if you've sold any type of long-term care insurance in the past, you know this decision is almost like folks buying a mortgage. Doesn't happen in a one-and-done appointment. It takes time for them to make sure they're making the right decision. It's affordable. They've got the right solution in their hands. And so really, when we do a vested or 100% cash back, we're really taking away from the long-term care and life insurance benefit. We got to direct those dollars because that's a risk for the insurance carrier. Nationwide now has to know that there's a possibility 100% of that cash back has to go back to the policyholder. So there's some give and take when we're looking at these designs. So I do appreciate everybody hanging tight with us for almost an hour today. Again, if you think of any additional questions, want to see illustrations, get appointed with Nationwide, contact our team. Number here is 800-228-0008, or throw us an email, ltci@jetter.com. Again, thank you, everyone. Thank you, Alyssa, for a wonderful presentation, and I look forward to speaking with you all soon.